In today's video, I wanted to showcase the brutal power of inflation, its effects on your personal life, and what you can do to profit from it. As you may have heard, the United States is undergoing record high inflation numbers as we speak. Most things have gotten much more expensive in the last 2 years. In fact, according to official government numbers, we are experiencing a CPI of 7%. But the government numbers don't tell the full story. It's very likely that the true rate is much worse. We can measure how much worse by using a rather bizarre stat. Bear with me as I guide you through the lies our government has been feeding us by analyzing the Big Mac, America's favorite burger. Here's the story. In 1986, a Big Mac burger cost $1.86. Now using the CPI stats, we could predict the Big Mac price today, a price that should be exactly $3.96, representing a 147% increase over the last 35 years. But here's the thing, the actual cost of a Big Mac today is 43% higher than CPI has indicated. Today, a Big Mac costs $5.65, a showcase of how the official government numbers likely severely understate the true reality of inflation. Now you're probably thinking, well, that $1.70 difference between the government predicted price and reality isn't a big deal, and through the prism of a Big Mac purchase, it isn't. But apply that 43% difference to a house, and you see how a small government lie in the official inflation rate can lead to significantly lower quality of life for the average American. Now that you at least acknowledge that the government's measure of inflation doesn't really capture the invisible tax that is taking over our lives, I present you with another more shocking example. Taking it back to 1986 again, the average American made $6.20 an hour. The median house price was $92,000, and some simple math tells us that back then, the average American would have to work 5.08 years to buy a home in cash. Flash forward to 2021, now the average American makes $16.85 an hour, and the median home costs $408,000. Today, he or she has to work 8.2 years, a 61% difference in worked hours, and just another example of how the average citizen is losing as wages fail to keep up with prices. Now we have another issue on the horizon that could literally make inflation the single most important problem for Americans. A potential disaster is looming over the country, and very few are taking this seriously, despite repeated warnings from many prominent historians and professional investors. You don't have to believe me, just take a listen to Neil Ferguson, who's a historian at the Hoover Institution. He is the author of 16 books on the history of money, war, power, and catastrophe. And while you listen to him explain this future on the Lex Fridman podcast, keep in mind that the US went completely off the gold standard in 1971.
It's very easy to point to a great many episodes of very intense monetary chaos, even in the relatively recent past. In the wake of the First World War, multiple currencies, not just the German currency, multiple currencies were completely destroyed. The Russian currency, the Polish currency. There were currency disasters all over Central and Eastern Europe in the early 1920s. And that was partly because over the course of the 19th century, a system had evolved in which trust was based on gold, and rules that were supposedly applied by central banks. That system, which produced relative price stability over the 19th century, fell apart as a result of the First World War. And as soon as it was gone, as soon as there was no longer a clear link between those banknotes and coins and gold, the whole thing went completely haywire. And I think we should remember that the extent of the monetary chaos from certainly 1918 all the way through to the late 1940s. I mean, the German currency was destroyed not once but twice in that period, and that was one of the most advanced economies in the world. In the United States, there were periods of intensely deep deflation. Prices fell by a third in the Great Depression, and then very serious price volatility in the immediate post-World War II period. So it's a bit of an illusion. Maybe it's an illusion for people who've spent most of their lives in the last 20 years. We've had a period of exceptional price stability since this century began, in which a regime of central bank independence and inflation targeting appeared to generate steady below 2% inflation in much of the developed world. It was a bit too low for the central bankers' liking, and that became a problem in the financial crisis. But we've avoided major price instability for the better part of 20 years. In most of the world, there haven't really been that many very high inflation episodes and hardly any hyperinflationary episodes. Venezuela's one of the very few, Zimbabwe's another. But if you take a 100-year view or a 200-year view, or if you want to take a 500-year view, you realize that quite often the system doesn't work.
Okay, so if the system often doesn't work and the US is headed down the path of hyperinflation, what can we expect? It may not be as bad as most finance YouTubers make it out to be. After all, Germany, Russia, and even Israel have gone through episodes of hyperinflation, and yet today many of these countries are still functional democracies, some doing just fine economically. But there's no denying that when a currency fails, more often than not, a country enters a period of conflict, revolution, and massive change. So how do you protect yourself against that? Before I show you, I just want to make sure you hit that subscribe button if you're enjoying the content. Now back to the video. Well, there are many schools of thought, but one of the most secure ways to protect yourself is real estate debt. That may sound counterintuitive, but here is a great example, a showcase of how hyperinflation is a good thing if you have a 30-year mortgage. Famous finance YouTuber Dr. Sven explains in this clip.
Therefore, it is extremely important to keep in mind inflation while investing, to be protected against it and perhaps even take advantage of it. The best way to take advantage of inflation is perhaps a 30-year fixed rate mortgage on your home where you live in. The positive of a mortgage is, okay, 2% inflation, 3%, and every central bank, every monetary policy says we want inflation at 2 to 4%. That's their target. They're going to print money to keep inflation there because those that are in debt, governments, people, they take advantage of inflation because what you have to pay back is worth less. 2-4%, nobody feels it's stable inflation. So you have to think, okay, how can I take advantage of that? A mortgage, you start paying, you pay always the same rate, but the inflation should make it on a real term always less and less. 28 years from now, you will be happy that you took that mortgage to buy that home that you wanted or something like that. However, completely different story. How to buy real estate today. You have to invest a lot of time to do that.
So obviously the mortgage that you're paying right now isn't going to feel the same in 28 years because of the effects we mentioned earlier. It's actually going to be easier to pay because you locked in a low rate that is likely far below the average rate of inflation for the next 30 years. Your wages and the price of homes around you will likely appreciate over the term of your extremely long loan, one that only requires a 20% down payment today. This makes a mortgage one of the best inflation hedges money can buy. People have obviously recognized this and home prices have shot up to crazy levels, so the deals aren't the same as they were when that video by Sven was created back in 2019. But the idea still stands if you're able to find a great deal. In a hyperinflation scenario, your mortgage would actually be wiped away, and we'll get to that later, but let's move on to something that's also mentioned in almost every video talking about inflation protection. The classic equity hedge. Believe it or not, in most cases during times of high inflation, the stock market generates positive returns, but only through the prism of the currency that is being devalued. This is where I see most YouTubers make a massive mistake. I've mentioned this many times on this channel and I'll repeat it once more. Even during Weimar Germany's catastrophic currency collapse, the German stock market performed well in the same period. The same could be said for Argentina and Turkey, which both recently saw massive record-breaking inflation numbers, yet their respective stock indices kept pace with this devaluation. But there is something very few people will tell you, something shocking that should make you reevaluate your protection plan. In real terms, adjusted for the cost of living, the German stock market was a complete disaster during this period of peak hyperinflation. There's a great video by a very small creator called Zen Economics that breaks down the situation. I've linked it in the description below, but ultimately, the summary is this.
That's an 84% decrease. So stocks lost 84% of their value during the hyperinflation. So when you hear that shares did well during Germany's hyperinflation, which is a popular and misinformed narrative out there, probably because people only look at nominal price, you now know that that's not the case when inflation or gold adjusted. And let's pull up that prior chart to really drive this point home. So here's the prior chart. You can see the cost of living relatively stable. I mean, it's increasing, but look at the price of stocks. So you could see there if you bought in 1920 or so, you could see there you did get a net gain in stocks. Now let's compare that to this next chart. This is the entire year of 1922 from January to December. So check out the price of stocks. For most of the year they weren't doing much at all, and then in December they skyrocketed. But look at the cost of living. The cost of living started rising earlier in the year, and it actually had a much larger blow off top. So seeing those charts next to each other like that, hopefully that drives home the point that yes, stocks did rise in Weimar Germany during the hyperinflation, but the cost of living was rising faster, and on net people were losing out.
I'll admit that I myself have used the example of Weimar Germany as a showcase of how investing in equities can protect you against hyperinflation. And while it may be better than cash, as Zen Economics just explained, stocks were a terrible investment during this crucial time in Germany's history. In fact, they lost over 84% of their value when you adjusted via gold standard. So stocks may not be the safe haven you were hoping for. Real estate, on the other hand, especially real estate financed by low-rate mortgages, could be a great investment. Zen actually has a couple of videos that break down in detail what was happening during this wild time in Weimar Germany. Now obviously, the Germany of then is not an apples-to-apples comparison to the United States right now, but it's one of the few instances in recent history where we saw a developed country undergo a complete currency collapse. So if you're looking for clues on how the various markets and society could react to a scenario similar to that, I suggest you check out his channel. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed, and if you have a moment, don't forget to follow me on Twitter. That link is in the description as well.